You're at the digital checkout screen. The total is high, and your bank balance is tight, but a small button offers an alternative. Split the cost into 4 interest-free payments. You get the item now, paying only a fraction today. Selecting that option provides a wave of immediate relief. It feels like a responsible compromise, allowing you to manage your cash flow without the high interest of a traditional credit card. Retailers pay significantly higher transaction fees to offer these installment services than they do for standard credit processing. They accept these costs because the ability to split payments drives a measurable increase in conversion rates and the average size of each sale. By dividing the total into smaller pieces, the platform allows consumers to commit to higher total costs than they would with a single payment. It effectively clears the path for a much larger final bill. This data shows the difference in spending between traditional debit users and buy now, pay later shoppers. Research reveals those using installments spend 4.4 to 6% more than standard shoppers. There's also a proactive shift in behavior. When consumers simply anticipate having access to deferred payments in the future, their current debit card spending increases by 3.1. The individual payments are small enough to slip underneath your emotional threshold, effectively neutralizing the brain's internal brake pedal. This mechanic pairs with present bias, our psychological tendency to overvalue immediate rewards while discounting consequences that occur in the future. When you split a payment, you acquire the product instantly. That immediate gratification overrides the abstract realization that 3 more automatic deductions will hit your account over the coming weeks, quietly constricting your future cash. The math of the split effectively disables a built-in restraint. By delaying the full cost, the mind optimizes for an instant hit of dopamine rather than long-term financial health. This delayed depletion triggers a mental accounting effect. Because the checkout screen only deducts a quarter of the purchase price, users often misjudge their true available balance in the days that follow. You check your banking out and see an artificially inflated amount of available funds. The uncollected debt exists, but it is not yet reflected in your account balance. This false sense of wealth has a measurable impact. Data shows that users who hold this inflated perception of their balance are 22.2% more likely to purchase a secondary, entirely discretionary product. The deferred payment structure distorts your financial reality, using your own bank balance to create an illusion of control while you quietly accumulate new liabilities. As the weeks pass, the timeline shifts. The psychological experience of the purchase changes as multiple installment dates begin to hit the account simultaneously. A Swedish academic thesis recently documented this emotional whiplash. The initial joy of the transaction inevitably fades into guilt, denial, and stress as the reality of the debt becomes tangible. Many young consumers manage this emotional burden by returning to the digital storefront. They make a new deferred purchase, seeking that original hit of dopamine to alleviate the stress of previous payments. Researchers describe this self-reinforcing loop as unaware addiction. The platform functions as both the source of the consumer's financial anxiety and their primary escape mechanism, locking them into a continuous cycle of consumption. When this loop is scaled across the global economy, the numbers become staggering. Top lenders originate over 180 million microloans every year. This creates a systemic danger, known to economists as phantom debt. Unlike traditional credit card purchases, most of these installment loans are invisible. They operate in a regulatory loophole where they are not reported to major global credit bureaus. Banks and traditional lenders now have a massive blind spot regarding the true liabilities consumers are carrying. Meanwhile, delinquency rates for these invisible loans have quietly climbed over 2%. The same mental accounting error that blinds an individual consumer to their debt has successfully blinded the global financial system to a multi-billion-dollar credit market. Regulatory bodies like the Consumer Financial Protection Bureau have attempted to step in to protect the public from this growing crisis. The Bureau issued a rule to classify these providers as credit card issuers under the Truth in Lending Act. This would have legally enforced basic consumer protections, such as the right to dispute charges and receive refunds. Industry groups responded with aggressive lawsuits, challenging the Bureau's legal authority to apply traditional credit rules to these novel fintech products. Relentless litigation and shifting political winds have recently forced the Bureau to announce plans to revoke those protective rules, ensuring the industry remains a regulatory Wild West. This leaves the Pay in 4 button exactly where it started, as a quiet danger resting in everyone's pocket. The model represents a scientifically optimized loophole. By bypassing financial defenses, it quietly transforms a consumer's desire for control into a cycle of invisible, inescapable debt.